Hello, I'm Sue Lloyd, Vice-Chair of the International Sustainability Standards Board. I'm going to provide you with an overview of IFRS S1, our general requirements for disclosure of sustainability-related financial information standard. Although this presentation will focus on S1, S1 and S2, our climate standard, are a package. So in some instances, I'll make references to S2 to explain some of our key concepts. So IFRS S1 is our foundational document. It sets out the general requirements for a company to disclose information about its sustainability-related risks and opportunities that's necessary for investors when they make decisions relating to providing resources to a company. To make sure it's connected and can be considered alongside financial statements, the information is disclosed in general purpose financial reports. IFRS S1 sets out the core content for a complete set of sustainability-related financial disclosures, establishing a truly global baseline of sustainability-related financial information to meet the needs of global capital markets. S1 applies the structure of the TCFD recommendations whenever a company provides information about sustainability, an approach that's already used by many companies around the world that use the TCFD recommendations. S1 requires industry-specific disclosures to be provided so that companies can focus their reporting in a way that better describes their business and provides useful information for investors. To help companies to identify their sustainability-related risks and opportunities and disclosures for matters other than climate, which is covered by IFRS S2, S1 refers to other sources, for example, the ISSB standards. This means that companies have the toolkit they need to disclose material information about all of their sustainability-related risks and opportunities from day one. IFRS S1 can be used in conjunction with any accounting requirements, while benefiting from having been designed using concepts from IFRS accounting standards to help build connections to financial statements and to deliver a holistic reporting package. This slide sets out the contents of S1. I'll go into more detail about some of these areas over the following slides, but I wanted to share with you first how S1 is set out. So S1 has 6 sections: the overall objective of the standard, the scope of the standard and the ISSB standards at large, the conceptual foundations of sustainability-related financial information, which includes the requirements on materiality and connected information, the core content disclosure requirements relating to governance, strategy, risk management, and metrics and targets, general requirements including the location of disclosures, the timing of the required reporting, and the statement of compliance, and requirements relating to judgments, uncertainties, and errors, with IFRS S1 asking companies to disclose information to help investors to understand the significant judgments they made in preparing their sustainability-related financial disclosures, to disclose information about the most significant uncertainties affecting the amounts that were reported in their sustainability-related financial disclosures, and to restate comparative information relating to previously reported errors unless it is impracticable to do so. As I said, S1 sets out the overarching requirement for a company to disclose information about its sustainability-related risks and opportunities to meet the information needs of investors. Here we mean those risks and opportunities that investors would be interested in. We don't mean every single risk and opportunity that a company could be affected by. S1 describes this objective by referring to risks and opportunities that could reasonably be expected to affect a company's prospects. That means its cash flows, its access to finance or cost of capital over the short, medium, or long term. Companies identify which information to disclose to investors using the concept of materiality. We use the same materiality filter that's applied in preparing financial statements, so it's the same concept that those applying IFRS accounting standards are familiar with. To assess if the information is material, you need to assess if it was omitted, misstated, or obscured by other information, which means that it has the same effect as if it were omitted. It could be reasonably expected to influence an investor decision. Why is this important? Because we want to make sure that our standards enable companies to communicate the important information to investors in the market efficiently and effectively. It's important that we be clear about why sustainability-related information matters to investors. A company's prospects are inextricably linked to how it works with and serves its stakeholders in the community, how it operates in society, and the natural resources that it draws upon throughout its value chain. We want to enable a company to explain how it maintains its resources and relationships, how it manages its dependencies on them, and how its impact on these resources and relationships gives rise to sustainability-related risks and opportunities for the company. We've built upon concepts from the Integrated Reporting Framework to describe this link. It's important for the information to be connected to financial statements so that investors have a complete, consistent, and holistic understanding of a company. The ISSB has made significant progress in facilitating connections between sustainability-related financial disclosures and financial statements by including concepts from IFRS accounting standards and the Integrated Reporting Framework in S1 and requirements for connected information in IFRS S1 and S2, including connections between sustainability-related risks and opportunities and disclosures on core content. Connected information requirements within S1 include that sustainability-related financial disclosures shall be prepared for the same reporting entity and the same reporting period as the related financial statements, be provided at the same time as the financial statements and as part of the general purpose financial report, which also includes the financial statements, include financial data and assumptions that are consistent with the corresponding financial data and assumptions in the financial statements to the extent that that's possible, considering the requirements of the accounting standards that a company is using. And that's all designed to ensure that the package of information containing the financial statements and the sustainability information resulting from applying the ISSB standards work well to deliver a package of information to inform investors. As I mentioned, companies that use the TCFD recommendations will already be providing information about their core content areas, which are illustrated on this slide. S1 requires a company to disclose information about its governance, strategy and risk management, as well as metrics and targets in relation to its sustainability-related risks and opportunities. These four content areas reflect how companies manage those risks and opportunities. As I briefly mentioned earlier, S1 points to other sources of guidance to help companies identify which risks and opportunities to report on and what information to disclose about those risks and opportunities. S2 sets out the requirements for climate-related disclosures when that's identified as a topic that information needs to be provided about. For topics beyond climate, S1 explains how to think about this. Firstly, when identifying what sustainability risks and opportunities to report on, S1 says that consideration must be given to the ISSB standards. So a company should look there first for information that meets the needs of investors. In addition, companies may consider other materials, specifically the CDSB framework, industry practice, and materials of other investor-focused standard setters. After a company has identified what to provide information about, S1 tells companies how to identify the particular disclosures to provide about that sustainability risk or opportunity. Here again, S1 says an entity must consider the ISSB standards. In addition, companies may consider, to the extent that the information would meet investors' information needs, the CDSB framework, industry practice, materials of other investor-focused standard setters, and, in this case, the GRI standards and the European Sustainability Reporting Standards to the extent that they meet investors' information needs. So in summary, there are instructions within S1 from day one to facilitate reporting on all important sustainability risks and opportunities that a company's investors need information about. We know that applying the ISSB standards will be a big change for many. To help companies get ready to report using S1 and S2, the ISSB provides relief in the first year that the standards are applied. There are 5 reliefs provided in the first year of application. Firstly, companies can choose to limit their disclosures to information about climate-related risks and opportunities, and to begin reporting on their other sustainability-related risks and opportunities from the second year that they apply the ISSB standards. Whereas ultimately the sustainability information needs to be provided at the same time as the financial statements, in the first year, companies can provide annual sustainability-related disclosures with their next half-year reporting, rather than at the same time as the financial statements. And then there are other reliefs to assist companies in the first year that they use the standards. The companies do not need to provide disclosures about Scope 3 greenhouse gas emissions. If they already measure emissions using something other than the GHG Protocol corporate standard, they can continue to use that different measurement approach in the first year. And in the first year, comparative information need not be provided. Companies that limit disclosures to climate-related information in the first year also don't need to provide comparative information about their other sustainability-related risks and opportunities beyond climate in their second year. These reliefs are all designed to help companies to get time to put in place their new reporting practices and structures to provide high-quality, decision-useful information using the ISSB standards. IFRS S1 and IFRS S2 are effective for annual reporting periods beginning on or after the 1st of January 2024. Jurisdictions can, however, make different decisions about when they require companies to use the standards. A company using the standards can also choose to use them earlier than 2024, as long as they use both IFRS S1 and S2 together and disclose that they are doing this. Why did the ISSB decide to use a 2024 effective date? The primary reason is pretty straightforward. The ISSB is responding to an urgent demand from investors for decision-useful, comparable information about sustainability-related risks and opportunities, and in particular, an urgent need for better information about climate-related risks and opportunities. Also, we're not starting from a brand new position. S1 and S2 build on well-established standards and frameworks, for example, the TCFD recommendations and the ISSB standards. And that means that many companies are already advanced in their disclosures and well prepared to use the ISSB standards. Also, we've put transition reliefs in place to support companies who are starting their reporting practices and structures. And companies who comply with the disclosure requirements have the benefit of requirements in the standards that enable them to use information that's reasonable and supportable, but that which is available without undue cost and effort. We also acknowledge the fact that the CDP is going to incorporate the S2 climate-related data in its platform for the 2024 disclosure cycle. So that provides an overview of S1. Please check out our other webcast on S2, our climate-related standard, and you can access both of our standards now on our website, ifrs.org. Thank you for listening.